Hello and welcome to this month's Market Compass. In May, markets reached another milestone as the Dow Jones Industrial Average crossed 40,000 points for the first time. While 40,000 is an arbitrary number and simply a psychological threshold, it is symbolic of the market's resilience in the face of high interest rates. In today's episode, we'll discuss whether the fundamental conditions support the move higher in stocks. Can the rally continue, or will it fizzle out? A good place to start as we look for an answer to this question is corporate profits, which is one of the more lasting determinants of market performance. While in the short term, markets are influenced by investor sentiment and headlines, over the long term, they are guided by the trend in earnings generated by corporate America. Before we dive into earnings, it is helpful to provide some historical perspective by comparing the current rally in stocks against past bull markets. While the S&P is up about 50% from its October 2022 lows, these gains are not outsized, not at least relative to what's happened in the past. This graph shows the average path of the last 12 bull markets going back to 1949, as well as the range of outcomes 2 years after a major bottom in stocks. Until the start of the year, the current bull was among the weakest in history, and since then, we've been simply catching up to the average. As of May 20th, all major indices are at all-time highs, but so are earnings. Forward earnings estimates for the S&P declined about 6% in 2022 as high inflation squeezed profitability. But earnings have been accelerating over the past year and are now 8% above their prior peak. As you can see, over time there is a close relationship between prices and earnings. Therefore, as earnings go, so goes the market. Results for the first quarter earnings season, which just concluded, reinforce our belief that S&P earnings are on track to grow around 10% this year, with growth likely accelerating in the back half of the year. Company earnings for the quarter exceeded analyst estimates by 8.5%. This is the biggest upside surprise since the third quarter of 2021. A strong but gradually slowing economy is supporting healthy revenue growth, while profitability is improving as the increase in costs is moderating. In our view, the key takeaway is that rising earnings provide a strong foundation for the uptrend in stocks to persist. Another factor helping markets reach new highs was April's deceleration in inflation. This added some confidence that the Federal Reserve might be able to cut interest rates in the back half of the year. If there is one risk that can disrupt the market's calm, in our view, it is any bumps in the disinflation story. The monthly pace of inflation is still higher than the Fed would like. But the April data was a good first step in re-establishing a pattern of lower readings. Recent data suggests that economic growth and the labor market might be softening. When viewed, though, through the lens of the Fed, a gradual slowdown could help bring inflation to target. With Fed policy rates most likely at their peak, we believe stocks can continue to build on this past year's strength. But the next phase of the rally might look different, with leadership becoming broader as more stocks, more sectors, and regions participate in the upside. Over the past 3 months, the Nasdaq 100, which represents the US megacap tech stocks, has lagged the S&P 500, which in turn has lagged the US midcap stocks and other major international equity indices. It is interesting to note that the asset classes that performed the worst over the past 12 months are the ones that have performed the best more recently. Sector leadership is showing a similar trend, with 8 of the 11 S&P 500 sectors outperforming the index. This signals broader market support than what we saw this past year, when only 3 sectors outperformed. Technology and growth stocks remain in favor. helped by excitement around artificial intelligence or AI. But over time, we could see the benefits of AI spread to companies that can apply it to improve existing processes. All in all, we see broadening leadership as a healthy sign for the longevity of this bull market. However, uncertainty around future Fed policy and November's presidential election could be catalysts for volatility in the months ahead. But the combination of rising corporate profits, the continued economic expansion, and the potential for lower yields provides a positive backdrop for stocks as the bull market continues. With that, thank you for joining us. We hope to see you right back here for the June episode of Market Compass.